As an NRI, you're constantly told that you're losing millions of dollars by not investing in mutual funds in India. But where do you even start? The answer is not what you think, and it will surprise you. Watch this video before making your first or your next investment. We will be discussing everything that you should know about building a mutual fund portfolio as an NRI. Hi, my name is Aswin, and you're watching another episode of The Home Advantage with Belong. Today, let's talk about which category of mutual fund you should invest in, how to choose the right funds, should you do SIP or lump sum investment, and finally, how to mitigate the currency risk. The term mutual funds is so common nowadays, but 95% of the people don't know which funds to invest in. So let's address this. First of all, mutual funds are divided into various categories based on the assets they invest in. For example, mutual funds that invest in the stock market are called equity mutual funds, and funds that invest in bonds or debt products are called debt mutual funds. Equity funds have higher risk, and debt funds are generally low risk products. So, which category of mutual funds should you invest in? This question cannot be answered in a single sentence because this depends on a lot of factors. Let me explain one by one. The most important factor is our investment goal. Every investment should have a goal. It can be your retirement, your children's education, or even a foreign trip. The longer the goal, higher the risk you can take. So if you're 30 and planning to retire by 50, you have 20 years to build a retirement fund. So you can start by making 90% of your investments in equity and keep reducing the equity component as you approach your retirement. At the same time, if your investment goal is to take a foreign trip in a year's time, you have limited time to take risks. So instead of an equity fund, go for a low-risk debt fund to park your money. Basically, understand your goals and plan your investments accordingly. The second factor is risk capacity and risk tolerance. Do you have a regular, steady income? Do you have an emergency fund? Do you have a family that's dependent on you? All these factors determine how much risk you can take. If you're in a stable job with good job security, you are assured of a paycheck every month. This makes it so much easier to plan your finances. You can plan it in such a way that a part of your salary goes into mutual funds. Even if the stock market falls, you don't need this money immediately because the rest of your salary will take care of your needs. Which means you can let this investment stay there for the long term and hence take on higher risks and go for an equity mutual funds. But if your salary is not predictable, you won't have the freedom to take on high risks. Now, having an emergency fund also has a huge impact here. Even if you don't have a predictable salary, if you have a good amount in your emergency fund, you can still take on the high risk. Because if anything happens, you have a corpus to fall back on. Now, having dependents is another factor that determines your risk capacity. If you're a 21-year-old unmarried guy who just started earning, and if your family is not dependent on you, you can take higher risks. You can go for an equity-heavy portfolio and invest for a really long time. But if you're a 35-year-old with a family dependent on you, you would think twice before making any investment. Because if anything goes wrong, it could directly affect your spouse and kids. So in this case, it's ideal to build a portfolio which is a mix of equity and debt to balance your risk. So in essence, your risk capacity goes down if you have people dependent on you. So now it's clear that your risk capacity depends on a lot of factors and it changes from person to person. Now, risk tolerance is something entirely different. It's more psychological. If you invest 10 lakh rupees in mutual funds, are you comfortable watching your investments go down by 2 lakhs? Well, this can happen in mutual funds. If you cannot withstand such falls, you should invest less in equity funds and add a good part of debt and a bit of gold in your portfolio. The risk tolerance is generally low for new investors, but as they watch more market cycles, they get more comfortable and the ability to withstand market falls will go high. The third factor is your age. There is a rule of thumb that you can invest more in equity when you're young, and as you age, you increase your debt allocation and bring down your equity component. It is logical but not complete. Let me tell you why. Yes, you can take on more risk when you're young, and as you grow older, you limit your risk. However, you have to club this with all the points that we mentioned earlier in this video. For example, let's say you're 22 but your entire family is dependent on your salary, and on top of this, you have an educational loan as well. In this case, you're not in a position to allocate 100% of your investments into equity, right? So it's not just about the age, but a combination of your age and many other factors. So now you know how to determine which category of funds you should invest in. But how do you choose the right funds? There are thousands of mutual funds in India, and out of this, 4 or 5 is all that we need. While picking these funds, the first thing to keep in mind is to not overcomplicate things. Keep things very simple. Index funds are a great option to consider for simplicity. They track an index and go with the market. So there's less of a headache as an investor. Every major index has an index fund these days. There are Nifty 50 index funds, small cap 250 index funds, mid cap 150 index funds, etc. You name the category, there will be an index fund for that. One major advantage here is the lower expense ratio, and this is something that every investor should keep in mind while picking a mutual fund. Expense ratio is a fee that the asset management company charges for managing the fund. Lower the fee, better the returns that you get. So while picking a fund, go for a fund that has a lower expense ratio. One important point here is every mutual fund has two plans, direct and regular plans. Regular funds have a higher expense ratio because there will be a commission element here. If you're investing through a financial advisor or a mutual fund distributor, you will be investing in regular plans and the commission goes to these distributors. However, if you're doing all the research by yourself and investing by yourself, you don't have to pay this commission. So in this case, always go for direct plans. This can potentially save you lakhs in the long run. Now, if you don't just want to follow the market and instead beat it, you will have to look beyond index funds and go for actively managed funds. These funds aim to beat the index and generate higher returns. You would have heard of large cap, mid cap, small cap, flexi cap funds, etc. This classification is based on the size of the companies that these funds invest in. Large cap funds invest predominantly in the top 100 companies in the Indian stock market, so they are less risky and deliver low returns. Mid cap funds mainly invest in mid cap companies which are smaller than large caps, so they are riskier than large cap funds but deliver higher returns. Now, small cap funds invest in the smallest companies. They are the riskiest but can potentially deliver the highest returns as well. Apart from this, there are funds like flexi-cap funds, multi-cap funds, etc. which invest in all these categories. These are the broad classifications of mutual funds. Now, as an investor, our goal is to build a portfolio by including all these categories. How much to invest in each of these categories depends on all the factors that we mentioned earlier in the video. Your age, risk capacity, risk tolerance, etc. But the end goal is clear. Build a portfolio for the long term that suits your goals. One important thing to keep in mind while building a mutual fund portfolio is the portfolio overlap. For instance, if you invest in two large cap funds, both funds invest in the same set of companies, this doesn't really help you. You have to unnecessarily track and study two funds without getting much benefits. So always make sure that the portfolio overlap is less. You can find many tools on Google to find the portfolio overlap between multiple funds. One final thing here, do not build a portfolio of more than 10 mutual funds. This unnecessarily complicates things. Most people just need 4 to 6 funds in their portfolio, including a gold mutual funds if you're interested. Always keep this number in mind. Understand that more number of funds just make things too tough. Now, once you figure out which funds to invest in, there are two ways to invest in mutual funds. SIP and lump sum. SIP or systematic investment plan is when you invest a fixed amount every month on a specific date. At the same time, making a one-time investment is called lump sum investing. So which one should you go for? An SIP is ideal for salaried people because the most important part of investing is consistency, and SIP lets you do it. Once you set it up, it happens automatically every month. This way, you're gradually building a habit of investing. Plus, if you're investing for the long term, SIP enables scattered buying. No matter if the market is going up or down, investment still happens. This way, we are removing the emotional element completely. Now, lump sum is ideal for people who get a bulk amount every now and then. You can invest in mutual funds whenever you get these funds. Even when doing SIPs, you can still invest as lump sum if you get some extra funds, like a bonus at work. The goal is to invest as much as possible early on so that you can build a good corpus by your target year. You can use strategies like step-up SIP to accelerate this process. That is, increase your investment amount every year by a small percentage. I also want to highlight the importance of emergency fund when you invest in mutual funds. This might sound a little odd. How are mutual funds and emergency fund even related? Well, there is a relation. Emergency funds and health insurance takes care of our needs if anything unexpected comes up, right? So if you're sorted here, you will not have to touch your mutual fund portfolio even if anything bad happens. This is very critical because wealth is built in the long term. It's the time that makes all the difference. So if you have to withdraw funds whenever a need arises, then you lose all the benefits. I personally know people who had to break their mutual funds just because they did not have an emergency fund. So make sure that you have an emergency fund and a health insurance as well. We have spoken about the factors to keep in mind while building a mutual fund portfolio, but there is an NRI specific issue that we did not address: the currency risk. You see, the Indian rupee is hitting new lows every day, which means keeping all your investments in INR might not be a wise idea. You have to assign a part of your portfolio to dollar denominated investments as well. This way, you save yourself from INR depreciation. This can either be done through international markets, or you can even consider Gift City, where multiple dollar-denominated investment products are available for NRIs. Gift City is a financial free zone in India where NRIs can invest in dollar terms without any taxes. And to access the various investment products in Gift City, you can check out Bilao, which is the first regulated investment platform in Gift City. You can find fixed deposits, mutual funds, alternative investment funds, etc. here. So choose the products that suit your goals. So through this video, I wanted to give you a clear idea about investing in mutual funds. I believe we covered pretty much every important factor to note while building a mutual fund portfolio. Feel free to comment if you have any questions. If you love what we're doing, subscribe and follow along. This is the Home Advantage. See you in the next video.